Okay, so it looks like we're about three after. We've had a number of folks come in. If other folks are logging on, then we'll obviously have them join. But I want to go ahead and get started on the process. Today, we're going to be talking about financial wellness and how fit are you financially. So the idea of today's presentation is try to connect the idea of physical fitness with financial fitness. So again, that process of becoming physically fit, it doesn't happen overnight. It's a series of steps that one takes, that one progresses upon to reach sort of the pinnacle of financial fitness. And the same really is true with financial fitness, that it doesn't happen overnight. There's lots of good decisions that need to be made along the way to build yourself towards that. Today, I'm going to be presenting. My name is Brian Stormont. I'm a certified financial planner and managing partner here at Insight Wealth Strategies. Joining me is going to be Alex Austin, who's a lead advisor here at Insight Wealth Strategies and also a certified financial planner. As we're going through the presentation, if you do have any questions on any items that we talk about, feel free to enter it into the Q&A section or the chat section of the hopefully the Zoom bar you can see on your screen. And so without any further ado, we're going to go ahead and get started on this. Alex, I was thinking in the spirit of trying to demonstrate good financial fitness, we might, show how committed we are to this and go ahead and throw on our headbands. What do you say?
Let's do it, Brian.
All right, let's get this going. So, Alex, we're going to talk today about some financial planning concepts, and the first one being that pyramid. And I'm going to let you go ahead and get started.
Thanks. Well, Brian, I also brought my weight as well, so really look forward to diving into this with you.
That is commitment right there. I love it.
So this chart really does a good job in outlining the hierarchy of financial needs. And so if we want to get physically fit, we need a framework to help us achieve our weight, our strength, and conditioning goals. If we want to get financially fit, we also need a framework to prioritize our money based on the stage of life that we find ourselves in. So if we think about getting in better condition, we need the basics like the right footwear or access to equipment. For financial fitness, we need the basics. The basics start with cash flow and basic needs. This level includes things like food, water, clothing, transportation, and shelter. We can't jump the gun when it comes to investing in our financial goals if we don't have cash flow and basic needs in place. It's also important to have consistent income or savings to afford things like food and shelter and other daily needs before we can focus on financial freedom and legacy planning. An important step to do this is developing solid career capital, which leads to having sufficient cash flow to meet our basic needs. Without this in place, it's hard to move towards our other financial goals. After we have cash flow and basic needs in place, we can focus on financial safety. The main pillar of financial safety is having an emergency fund and insurance in place. The emergency fund is there for unplanned or unexpected life events. This could be losing your job, medical emergency, or car repair. Brian did a really good video recently on what to do if you're laid off, and you can check that out on our YouTube channel, and we'll have the link below. Also, don't forget to subscribe to our channel and hit the like button so you get updates on future videos. Without an emergency reserve in place, our goals for retirement and financial freedom will get derailed and could result going into credit card debt since we don't have a financial cushion in place. A good planning rule of thumb is to have 3 to 6 months of expenses and keep it in a high yield savings account. Many today are paying at a rate above 3%. The key here is liquid. You want to be able to quickly and easily access the money without any penalties. Earning a big rate of return is not a priority here. Having it accessible is. Financial safety also means protecting ourselves through good insurance. The 4 main insurance types that we can't live without are homeowners, auto, health, and life. Spending money on good insurance is like buying good running shoes that cushion your feet and reduce the impact while running. A study published by the American Journal of Public Health found that nearly 70% of bankruptcies in the US are due to medical issues that can result in hundreds of thousands of dollars in medical bills. When we don't invest in adequate insurance like health insurance, these bills can easily wipe out our savings and retirement accounts, along with college education accounts and home equity. If we don't invest in good insurance to protect us, all of our hard work towards accumulating wealth and obtaining financial freedom and legacy planning can come undone with a single health issue or a fire that destroys our home. While dieting and eating well helps our physical health, good financial habits like budgeting, having consistent cash flow, and financial safety will grow our wealth, and good insurance will protect our wealth. Having that consistent cash flow to cover basic needs and financial safety in place means that we are building a strong foundation for the next levels of our financial hierarchy. So I'll turn it over to Brian to tell us more about accumulating wealth and financial freedom.
Alex, yeah, thank you very much. Yeah, the topics you're bringing up there are really spot on, which is we need to really focus on the fundamentals as we kind of get going in life. So there are points where people, they might need to ask some questions of a financial professional, and we're happy to have those conversations. We actually do a fair amount of pro bono work here, a lot of times with younger individuals who maybe don't need a proper financial plan at this point, but they just need some feedback on some really specific questions to their personal financial situation. And realistically, we're happy to just have those conversations and help them move along. But in the same way where, you're trying to get more physically fit. So you bought the shoes, you bought like the running gear, maybe you've got a gym membership. You're starting to move forward in that process, and you're starting to see some results from all that. Same thing in the financial space. So as we start to get our budget squared away and start to look to prioritize emergency savings reserves and put some of those protections in place, now we might have moved to a level where we begin to start to accumulate wealth. And the reality is that we start to introduce a little bit more complexity to the financial situation here. So ideally, if someone is looking to start to begin to save, once they've got that emergency savings reserve in place, then the question becomes, okay, what's the right path to be able to start to save? And certainly for us here at Insight, one of the first places we look to try to encourage savings to happen is oftentimes through the individual's employer retirement plan. So maybe it's a 403B or a 401k plan. And at a minimum with those plans, we want to make sure that if there's a company match, that individual is saving at least to get that. Because at the end of the day, that's almost like having free money added to the pile of money you're trying to grow. If a company 401k plan is in place, the second question often becomes, okay, should I be saving that money pre-tax or after tax? When we're dealing with younger individuals, we tend to like to see them save that money oftentimes after tax into the Roth. What we tend to find is that a lot of the times they're at a lower income threshold. And so that tax deduction of pre-tax savings just isn't as beneficial for them. Plus, that money that goes into the Roth bucket, it gets to grow and compound and ultimately come out tax-free. That young individual, at some point, they're going to probably grow into their career, and they're going to find themselves later on earning a much higher income. And at that point, that tax-deductible contribution becomes a lot more valuable. So some of those thought processes about which way I save my money is going to be really important both today in their present and as they look forward down the road. And then for some of those individuals that really are super savers, there's a strategy called the mega backdoor Roth strategy that many 401k plans offer to the employees these days. And that's an additional strategy that can help you save tens of thousands of dollars into the Roth IRA with no income limitations there. So again, areas we want to make sure that we're not overlooking. Now, not everybody has a 401k plan. So there we're looking again at more maybe traditional IRAs or Roth IRAs. And to the degree that those buckets are being utilized, now we want to then look at the brokerage account. So now we're talking about an after-tax investment account that we're looking to grow. And one of the beautiful aspects about this is that if you're leveraging all of these different buckets of money, when you get to retirement, you find that you have a lot more tax diversification in your financial situation than you otherwise would have. In fact, we often find that we have folks come to us when they want to retire and they've got too much money in the pre-tax bucket and don't realize that's all taxable to them. So that's when we start to build towards our goal. Now, to connect it back to that financial fitness concept, as we're building towards this financial objective, which for many people is financial freedom or retirement, at some point we're seeing success. we can see a light at the end of the tunnel. And so again, maybe from a fitness standpoint, this is akin to thinking, hey, maybe I should go out and try that marathon, or maybe I should sign up for that Ironman. So this is where we start to really see some significant success. And the reality is that the situation for these individuals is now becoming probably a lot more complicated. And so it's not uncommon that at this point, people start to think about maybe hiring someone like Alex or myself to help them do a comprehensive financial plan. So as we think about preparing for retirement, transition to retirement, there's tax planning strategies we want to be thinking about, investment allocation strategies. So hopefully, while you've been growing those assets, you've been more growth oriented, but at some point you're going to need to shift gears towards a more distribution oriented portfolio. What's the right time to do all that? So these are the steps that you're going to need to think about as you start to get really, really more advanced in this process. And that's where oftentimes a financial professional can make a big difference coming in. Now, once we kind of get to the pinnacle of that financial hierarchy, we're starting to think about the big picture and some of the legacy items. I'm going to turn it over to Alex to address some of those areas.
Well, thanks, Brian. Well, we're at the top of the pyramid. We've reached Ironman status. So throughout the way, we built a strong foundation. So we've reached financial freedom, and legacy planning is our next area of focus. So let's start off with tax planning. So it's interesting, Brian. A lot of people confuse tax planning with tax preparation. Tax planning is looking ahead and identifying what strategies we can do today that's going to reduce our taxes in the future. There are times where we can use Roth conversions, or even recently with a client, we used a reverse gift strategy that's going to help her reduce her taxes in the future. Tax preparation is looking back and what you did last year and how much you owe in taxes or get a refund back. This is similar in getting physically fit and using meal prep by looking ahead and getting the ingredients ahead of time to ensure that you're eating well to reach your fitness goals. Another key part of legacy planning is estate planning. So, Brian, what are your thoughts on that are?
Yeah, so estate planning, this is a really critical subject. So what you're trying to do here is make sure that you've got some sort of documentation in place so that, God forbid, something happens to you, the people that you want your assets and resources to flow to get those assets and resources as quickly as possible. So for some people, that might be some simple will, just naming who you want to get your various assets. For many people, though, here, certainly in the state of California, if you own any sort of property, you're probably really looking at it wanting to get a revocable living trust. So here, what we're trying to do oftentimes in California is we're trying to avoid probate. So probate is the process that all Californians who have assets above a very low threshold have to go through, or certainly their states have to go through, to distribute their assets. It's very slow. It can be quite costly. It's best to try to avoid it if possible. And a revocable living trust is a great vehicle to do that. Now, past that, trust can also do some other really interesting things. For example, it can give you a lot more control over how assets are used. So as an example, I've got 3 young kids. If something, God forbid, were to happen to my wife or myself, I don't want those assets being available to them when they turn age 18. That, to me, would be a terrible idea. So you can add control over that. And then past that, you can get into some really neat customization areas to avoid the estate tax. But again, those are some of the areas that I think make a lot of sense. Alex, you got any additional thoughts on there?
Well, I think that you covered pretty well. I think just creating estate planning, a lot of people neglect that and just assume that they don't have a estate that's material enough. But if you have a house, if you have kids, any kind of assets of even if it's modest, you're going to want to do at least some basic estate planning in place, because the probate cost, it can be, as you mentioned, timely process, costly. It just means there's less money to distribute to beneficiaries. So it's good to be able to outline how you want assets distributed and how it flows downstream versus letting the courts decide that, because it may not get to who you want it to end up to.
Yeah, absolutely. And so again, what we're trying to really kind of connect today is the idea that as your financial situation gets progressively more, say, complicated, as you move up that pyramid, the need to basically leverage additional specialists or people, knowledge and resource centers to maybe think about your individual situation probably becomes more apparent. And so oftentimes the question becomes, okay, well, who do I use? Who can I reach out to? And there's lots of financial firms out there. Alex, any thoughts as to why someone might, choose Insight, for example?
Yeah, absolutely. In getting fit, in getting physically fit, you have a lot of gyms, fitness apps, and other options that are available. Same holds true for getting financially fit. Here at Insight, we help a lot of people get financially fit. We are a boutique firm that does comprehensive financial planning, getting clients to and through retirement. Each client here has a dedicated team to help them with all of their planning needs. We are also fiduciaries, which means we put your interests first. And we are a fee-only planning firm, so we don't sell any products or earn any commissions. All of our planners have many years of industry experience and are credentialed, including having their certified financial planner designation, like Brian and myself, which is highly regarded in the industry. So we love to help you and your financial fitness journey and encourage you to reach out to us. Brian, do you want to cover some of the financial planning services that we offer?
Yeah, absolutely. Yeah, a lot of times when folks initially engage with us, they're thinking that we're there to just help them with their investment account, and that's certainly true to some extent. But realistically, we look at most, if not all, of our clients in a very holistic way. And so the diagram you're seeing on the screen here encompasses a lot of the work we do with many of our clients. Not every single one of these items applies to every single client, but many of them do. And I would argue that initially, one of the most important parts of this diagram is that upper left quadrant, which is the retirement planning side. So really this for a lot of people is their primary financial objective. And they want to make sure that they can afford to retire, that they understand what their cash flow strategies are going to look like, that they know when they're going to start Social Security benefits or how they're going to access health insurance benefits, that they know how they want to arrange or structure their portfolio to meet their needs. So that's a critical part of the overall planning process. And in my opinion, a lot of the other parts of this diagram flow from the knowledge of how that individual is situated relative to their retirement goals. So things like long-term care need or estate plan structure or investment allocation or tax strategies. I think a lot of that actually flows from a fundamental knowledge of how the retirement situation looks. With that said, I know that we would love the opportunity to get a chance to answer any questions that may come in today. In fact, actually, it looks like we did get a few that have kind of popped in as we've gone through the presentation. So, Alex, here, I'm going to shoot this one over your way. So the first question that kind of rolled in was, how early should I start working with a financial advisor?
This is it's a good question. I would say it's never too early to start some planning. And we work with clients at different stages in their financial journey. And so just getting started means that you have a good roadmap in place. So you can focus on working your financial plan year in, year out, with attention to how much you're saving, where you're saving, and being tax efficient along the way. So I don't think it's never too early to start at least some basic planning.
Yeah, I couldn't agree with you more. I think that again, just to kind of echo some of the things that happen in our world, it's not uncommon where we have someone who's young who just might have one or two questions that are one-offs that they are curious about, and we're happy to have that conversation with them. They may not need comprehensive financial planning in that case. Maybe it's something where we say, you know what, in 5 years when these certain circumstances are met, why don't you call us and we can talk at that point. Another question that came in, so I'll field this one. It says, I've been doing okay managing my assets by myself. What would be the advantage of working with an advisor? So great question here. Again, a lot of times people just assume that working with a financial advisor means that they're managing your assets. And frankly, that is oftentimes the case. A lot of people realize that managing a portfolio in a sophisticated way is a lot more undertaking than maybe they have the bandwidth for. But some people are really good at it, and they just want a financial plan. And because we're a fee-only firm, meaning that we either are deriving our revenue from either managing assets or from doing a comprehensive financial plan where we charge a flat fee, we're frankly agnostic. So really the question from our perspective is, do we believe there's an opportunity where we can help someone materially with their financial situation? So that's where we would look to say, hey, what are some opportunities that we have there? Alex, another question that came in, I'm at the legacy level and feel like I just need to maintain my wealth. What should I do now? What do you think about that?
Yeah, I would say that this is a big part of this stage is updating and monitoring the plan. And so if we think about someone's financial life, it's not static. It does evolve over time. And so, for example, you'll want to review your estate planning documents periodically to make sure that beneficiaries are correct. Is the trustee or is the executor the right person? Are there new assets that we should be including in our estate planning document? So those are the few considerations that you want to review. You also want to make sure that your plan reflects your current financial life versus something you did maybe 5 years or 10 years ago. So it's important to actively update and monitor our plan as we go along in life.
Yeah, those are great points you make there. And, one that we've been talking about with clients a lot recently was just the Secure 2.0 Act that went into effect in December. Almost 100 changes to retirement accounts that happened out of that piece of legislation. So we're having conversations with clients actively today to say, hey, here are the new rules. Does this have any impact on your situation? Certainly a couple of years ago, there's some pretty significant changes on the beneficiary flow of assets for retirement accounts, how that works. It has some pretty material impact on some clients who've done some planning up to that point. One last question that did just filter in. So a question regarding our fee structure. So really, as I think we kind of alluded to, we're a fee-only firm. So we don't sell financial products. We don't derive commissions for selling financial products. There's really one of two ways that we get paid. Either we're managing the client's assets, where we're charging typically a flat 1% management fee for the assets that we're overseeing, or if we're doing a comprehensive financial plan, we're charging a flat rate for that financial plan, where we're creating the financial plan and going through a series of meetings with the individual. So again, we often basically say, hey, let's just have a conversation first, see if there's any need there, and then we can figure out, okay, what's the best course of action to approach this? Our approach here at Insight has always been, pretty low key. We're just looking to have a conversation and see if there's ways that we can be helpful for everyone. So for the attendees who are able to join us today, I really want to thank you first and foremost for being able to stop in and listen to some thoughts that we have about financial fitness and health fitness, and how those two actually do have some connection with one another. As you can see on the screen, there's our contact information. We've got offices here in Northern California. We also have offices in Texas. And frankly, we work with clients all across the country. So we would certainly welcome the opportunity to have a conversation. Alex, any last thoughts before we sign off today?
Well, I think this has been really good. I was thinking back to the prior question about managing assets by yourself. I would say it's hard to do comprehensive financial planning just using Excel. Tax codes are going to change. There'll also be variability in financial markets. Required minimum distributions will change. We just saw that in the Secure Act 2.0. Mm-hmm. So it's helpful to have some expertise. So to make sure you're making the right moves and to be able to reach your financial and retirement goals. And so you don't want to make a mistake that you can't recover from. And so just like training and fitness, we can always get better, be more optimized. The same is true for financial planning, especially as conditions will just continue to change.
Yeah, absolutely. Well, hopefully this is going to provide some good food for thought. And we very much, again, thank everybody for attending the presentation. And we very much look forward to an opportunity to have a conversation with you. Again, Brian Stormont, Managing Partner at Insight Wealth Strategies, Alex Austin, one of our lead advisors here on the team. Thank you so much for coming, and we hope you have a wonderful rest of your day. Thanks, guys.